Hello, this is Phil at the Laptop Trader channel on YouTube. Welcome back to our community. I'm here to share my experience and give back to the stock investing and trading community, one video at a time. This channel is going to cover market cycles, stocks, and ETFs, technical analysis, trade entry, trade management, risk management, and how to create confidence by putting the odds in your favor. Good luck. My email contact for questions is laptoptraderphil@gmail.com. Caution, most stock traders lose money. Please protect yourself at all times. Nothing discussed in this video is trading or investing advice. This channel is for informational purposes only. Please seek qualified help if you need help investing. Where to start? Start now by educating yourself on how markets work and finding out what is right for you. Invest in yourself and then invest in the markets. For April 2024, our agenda, we've got quite a bit to get through. I think there's going to be 80 some slides on this, so I am going to move quickly. If you need to uh, maybe stop and pause and review any of this information, that may be a good idea. So we're going to our monthly review of technical basics, including trend stages, management, pivots, multiple time frames, etc. And then I've got a few new um, slides of different patterns to look for, including a buy setup or a 3-bar turn, a breakout, breakdown, basing patterns, price contraction patterns, wedges, um, how to become a price detective and follow the leaders, how to read the economy, um, which was an unexpected benefit when I first got into technical analysis. I never thought I would actually be able to read the economy the way I can read the economy now. It's really kind of empowering where you're not so scared. If you're watching a lot of financial news or nightly news reports on the economy, I think that can get confusing. Uh, which time frame is best for me? That was a question I had early on when I was exposed to multiple time frame analysis. So I think that's one topic we're going to cover this month. We're going to cover the current market environment using charts. We're going to be looking at just different charts of whether it's the VIX, the SPY, the NASDAQ, QQQ, etc. I've got over 50 charts for you guys this month. Um, then I've got 8 current charts on my list for April. You should have a list yourself. So what is on your list? If you don't have one, get one. I think it'll really help you start to help you analyze the market if you're new. The goal of this channel is to inform and empower you to make better financial and investing or trading decisions. When you have knowledge and confidence, you will feel empowered in your personal finances. Stick with it. This is not taught in school. And then this channel is going to be repetitive. So repetition is key. And it's just, practice makes perfect. So again, what time frame is right for me? This is going to depend on your lifestyle and your time commitment to investing or trading. It is a personal choice, and it took me quite some time to figure it out for myself. I would say this took me really to get a feel for it 6 months to a year to give you a number for that. I was able to trade during the week by setting up my trades on the weekend and entering orders into my online broker. This allows me to keep my day job and also trade. It also it is also time efficient, and I do not have to be at my computer during market hours. I do sometimes live trade or watch the markets during the week, but that is not the norm. Also, what is your experience and are you capitalized enough to day trade? A lack of experience or money will slow you down, and it is better to start slow, as it is a different industry than what you are probably used to. One of the secrets to using time frames is MTF, or multiple time frame analysis, which keeps us on the right side of the market. I refer to myself as a price detective, as I look for clues to the next probable move in any market or stock. Technical analysis is the study of price action over time and trying to predict future possibilities. We try to put the odds in our favor and play those odds with calculated risks. There are no guarantees. By looking at the markets this way, we are able to follow the leaders of the market who dominate the financial industry and actually move the markets. We are also able to get a very good grasp of what is going on in the economy in general and what industries are moving at this time. I think through practice, you may also feel much more informed about the stock market and the economy as I am. I know this is a lot of information, but over time, it speeds up. For example, my weekly game plan only takes 1 to 2 hours to implement, and then during the week, I just keep track of what happens. Let's talk about management a little bit. Three types of management. There's personal money management, which includes a home budget and figuring out how to allocate the money that you have. This skill will transfer to the markets when you try to figure out how much to invest or trade. So this is going to happen before you ever take a risk. Unfortunately, we are inundated with marketing online of get rich quick in the markets, which isn't true. Then we have risk management. How much am I willing to risk on any one trade and what is appropriate for me? It should be a dollar amount you can sleep with. Further reduce risk with a stop loss strategy or share sizing. Share sizing is just limiting your risk by dividing your risk by the number of shares bought. A stop loss allows you to buy more shares than you would normally without a stop loss. So this again happens before you ever enter a trade. Trade management involves where to exit, when to raise your stops and reduce risk, when to add to a trade, when to take some or all of your gains. Was this a day trade or a swing trade or a longer term core trade? So you need to understand, again, going into a trade, what is the expectation for that trade? So different trades will have different expectations. This is a repeat slide of just my basic approach to the markets and stock selection. I will leave this up here for about 5 or 10 seconds, and if you need to pause, you can read through that. I'm not going to go through this slide this month. I'll just take a drink of water while you guys, if you want to read through that or pause. And then at the bottom, number 7 is just wash, rinse, and repeat. Again, this is a previous slide from other um, videos. Just a reminder, what one of my basic approaches is looking for what stage are we in this market or this stock at this time. So there's 4 stages. Again, this is a repeat slide. There's different names for the 4 stages and how they may be labeled in the media, or if you hear somebody talking about different terms such as distribution or consolidation, that's what they mean. There's really only 3 price trends within any market. Price can go sideways, be an uptrend or a downtrend. And then I put this slide together a while back, kind of wrap it up in a picture for you of what type of action you may take depending on which stage we are in for that particular stock or that market. The nice part about technical analysis is it applies to any market. It could be commodity, future, ETF, stocks, options, forex markets. So this, once you get this skill, it's very powerful. This is a new slide this month. I wanted to add this in because, so just so there's no confusion, what is a price pattern? After we have determined the overall stage and or trend of a market or a stock, sometimes called our directional bias, right, up, down, or sideways, we are now going to look at the picture for a price pattern. In general, if we look at a larger time frame, like let's say the monthly time frame for our stage or trend, then we are going to go down in time frame to find the picture or pattern we're looking for to take action, whether to buy or sell or hold. In general, swing traders are going to use the daily time frame as their action time frame. This gives us a good time to enter and exit our trades, as it does not take up a lot of our time sitting in front of a computer all day, such as a day trader will do. So our context or bias will come from a larger time frame and our action will come from a lower time frame. This helps to keep us on the right side of the market and the trend. A day trader may use a daily or 60-minute chart as their bias or view of the trend and take action on the 5 or 15-minute chart or lower. With technical analysis, the choice is up to you based on your needs and time commitment as to how you will operate your business. Let's now look at some popular recurring price patterns that you may see in any time frame. Any of these patterns can break up or down, and so risk management is key to success. So I just put this together. These are, you know, 6 fairly common popular patterns. I drew all 6 as a breakout to the upside. Just understand that these can also be reversed and can break down to the downside too. So this is just an example. I labeled them, and so 1 would be a range breakout or a stock that's in a range or enters a range and then breaks out. The green arrow would show the entry point of a good time to get on board to take advantage of the next move higher. 2 would be more of an ascending triangle or an ascending breakout. Again, you would wait until price tightened up and then enter on the breakout. 3 is very similar. However, first there's a move up, and then there's a consolidation through price and time. and then the stock breaks out again. So just a little bit different look. 2 and 3 are very similar. 4 is also similar, but I believe a little bit more powerful because it generally gives you a very tight entry or a very tight stop loss and very good risk to reward. This pattern it's been around forever. It was really coined by Mark Minervini, and he called it a VCP, or volatility contraction pattern. I didn't want to steal that term. I just came up with a price contraction pattern, or a price over time contraction, and you can see there's a move up in the stock, such as this. And over time, there's really not much selling there, and buyers continue to pay higher prices, and then it breaks out again. And so that's a very powerful pattern there. I call it a price contraction pattern. 5 is basically a bull flag. The price moves up quickly and consolidates in a very tight triangle like that, and then breaks out again. Sometimes called a bull wedge. And then 6 is kind of just where stock makes a move up, contracts, so maybe it looks like this, but it's usually tighter, and then it breaks out. And this is an important one, because if you miss the breakout, right, let's say it breaks out here and you don't get on board, and you're like, dang it, I just missed that. I could have had a great trade. Don't let that get to you. That happens all the time. What you do is you wait for a buy setup. You wait for price to retrace to this area, which is called minor support, and then you look for the next turn, called a buy setup, or what I drew, and I'll show this on a later slide, a 3-bar turn buy setup. So it'll be pretty clear when we get through that. But this is a newer slide. Anyway, we look for price patterns because they repeat themselves and they offer good risk to reward trades. Remember, our stop loss is going to be based on previous price action and levels of support. Trading is a game of probabilities. Anytime we can reduce risk, such as with a tighter stop loss, we can have the potential for a higher reward or return on capital, which is why we generally wait for prices to tighten up and or break out to confirm our assumptions and our expectations. Think of pattern 4, how we can wait as price consolidates and contracts over a period of time. We let the market offer us a better entry and a better risk to reward. Think about that. We're going to let the market offer us a better entry and a better risk to reward. So we wait for the best opportunity. Here would be something else, a different kind of pattern. Basically, I call it a base and break. So this is going to combine a few of those patterns we just looked at. So bases or consolidations are an area to watch and see what happens next. Which way does price move? It is also a time correction, which gives us time to think about our next move. So if you think about it, if we take, this could be any stock or market, if this market or stock makes this move up, kind of plateaus or peaks, and then kind of comes down with these large red candles or bars, and then that gives us a clue, right? These large range expansion bars are a clue. Okay, that was some pretty heavy selling right after this big move up. And then we get this base over whatever period of time. This could be an hour for a day trader, or this could be 2 weeks. doesn't matter. But then we get a breakdown. And so this would be a base over a period of time and then a breakdown. And then we have another base here with consolidation, right? And then we get a clue with this large green bar or a break up. And then we get another consolidation, maybe almost a wedge. And then we're looking for the next break higher or the next break out. So a base and break is something to look for in charts as to the next possible direction for the particular stock or ETF or market you are trying to trade or that you want to trade. So this can give you a higher odds entry or also give you a clue as to a good time to exit. And this is just one of my pieces of art. Maybe I'll sell it someday, but just a basic wedge up pattern or up wedge and then a breakout. And after the breakout, comes back and you get this buy set up here for a high probability entry or trade. So, the reverse of that would be a breakdown out of a wedge pattern. If you're looking to go short or you're looking to short stocks, this would be something you could look for that. This would just be another example, another drawing showing a resistance area across this top line, a breakout, pullback with a buy setup or a 3-bar turn here. What these patterns are showing is pressure. We have buyers increasing the pressure by their willingness to pay higher prices for any particular instrument or commodity or stock or whatever. So as buyers are willing to pay more, it pushes prices up. Buying pressure is very powerful, and we can see it. So we can see that buyers are willing to pay more. So that's why these charts are very helpful. This is a repeat slide. This is what just a buy setup. I labeled it a 3-bar turn. There's nothing proprietary about that, so I just put this here. So if I ever abbreviate 3BT on a chart or something, that's what I'm talking about. Where and when this pattern happens is extremely important. We're generally looking for a pullback and an uptrend, and then we're trying to catch the next move higher. This shows some examples of where you may want to place your stop loss, where you could enter or exit or anticipate an entry. So this is this is a setup I use quite often. This is also a repeat how to read a candlestick as part of a candlestick or a bar chart. So I'll leave this here for a few seconds, and you can pause if you wish to review how to read a candlestick for our newer traders. Again, this is just another example of different candlesticks you may see on a chart. They form in any number of ways, but you always read them the same. I made this because if there's ever a question of what is a pivot, this is what a pivot is. Be a pivot high or pivot low. On daily, I use this on daily time frame for my action time frame. Pivots work on all time frames, so just a good definition of 3 bars to the left or the right of any peak or pivot low. This would be an example of how to combine the use of a breakout with a risk to reward example. Okay, so the share size for any size account, just take your trade or risk divided by your stop loss, and that would give you how many shares you would purchase for that particular trade. So if you had a $20 risk divided by a $2 stop loss, you could purchase 10 shares. The risk amount based on a stop loss strategy is generally referred to as share sizing, or R for risk, or RV for risk value. If someone says, I earned 4R on that trade, it means they gained 4 times their risk. This also may be referred to as ROC, or return on capital. That would be an example of where you would enter, where you would place your stop, what would be your expectation, and if it moved in your favor, how much you could earn, potentially. This is again a repeat every month. 3 basic rules to limit risk up front. Your account size does not matter, and neither does your ego. Right? Have a trading plan. Limit your position size. Use a stop loss rule if you wish to. This is a new slide. Why is money management so important? A fool and his money are soon parted. Without it, you may make or even win a lot of money, but you will most likely spend it all, or in the markets, give it all back. Think of the average lottery winner or highly paid athlete who had it all but gave it all away. Mike Tyson or Alex Rodriguez, or the guy who won $50 million in the lottery but blew it in 2 years. I believe Mike Tyson earned something around like $300 million in his career, some really high amount. And he doesn't have any of it. There are thousands of traders who gave it all back to the stock market. And if I chose to, I could probably put up one slide a day of somebody who lost all their money that day. It happens all the time. Money management starts at home with managing your own money. It is not so much about the money or being cheap, it is about the habits that you have with money and the skill of discipline with money. It is also about the emotions around money and self control, and the ability to delay gratification. Money is just a financial tool, but you must be in control of it. Budget. The reason why the rich get richer is so often because of money management, not because of status or because they were born rich, although that does happen, there's no question about it. I have seen many well to do kids blow their inheritance or college fund on living in the moment, or YOLO, you only live once. I have also seen many people start with humble beginnings, become quite wealthy, and keep it. The choice is up to you, and it is a choice. What if there is a great opportunity to invest just around the corner, and as you go around the corner, you simply drive by this opportunity because you were not looking for it because you did not have money set aside for the next investment. So you just drive by it. Well, is that society's fault, or the market's fault, or the city's fault, or is it your fault for not being ready? Get ready now for the next opportunity. Please don't waste your money on short term things that don't provide a return on your hard earned money. Always look for an ROI, or return on investment, or a return on capital. Let's practice our chart reading skills and look at some current market conditions and some other companies. I think you should be able to get a feel for the economy, markets, and stocks in general after this exercise. I'm also going to suggest that you put together your own list of companies to watch. Start with 10 or start with 100, and over the next month, watch and see which ones start to perform or underperform, which ones moved the way you expected, which ones broke down or broke out. Keep practicing and learning, as it is a learned skill. So this I put together as a multiple time frame exercise this month. This is the current chart as of Friday for the ETF of the S&P 500, symbol SPY. All we're looking at here is 4 different charts on the same page. So as we look at the higher time frames, this is a quarterly 10-year chart. We can see that over that period of time, basically, the stock market goes up, right? We've had a pullback here, a pullback, another pullback, and then the market goes back into an uptrend. So that's pretty common when you look at any longer term time frame of the overall market, as the S&P 500 would be a good example of an overall market, right? A good representation of the overall market. And then on the monthly chart, again, we see a very similar picture of an overall uptrend with, kind of this pullback, which was the bear market of 2022. And then as we look at the weekly chart, we can see a more detailed view over a shorter period of time. And where we had this pullback between probably August of 2023 into November of 23, and then a resumed uptrend until the current time. So what do you see here? You see uptrend, basically an uptrend with a bear market. Basically, again, a very strong uptrend with a pullback last year. And then on the daily chart, we could see this was that pullback right here, and then we've been in a pretty strong uptrend all year with some minor corrections in between. So let's go to the next chart. So that gives us our overview. That gives us our bias, and that gives us our market direction, and kind of our stage analysis, right? So we're in basically an uptrend. Now let's get some more detail to that. This will be a more detailed chart over the last 3 months. So the S&P 500 is still in an uptrend, but here, as we look at more detail, we have a double top, right? As prices moved up, we had this was a new high, and then we had a pullback, and we moved up. We made another slightly new high here, and that creates this double top pattern. And we didn't really make a significant new high. We just made kind of this weak new high, created a double top. And that is a little bit of a caution. Okay, that'd be like a yellow light on the road. Then we have another clue. We have this wide range bar, this red bar. You can see with this bar is larger than any other bar on this page, right? This is the largest bar on the page, which means pay attention, right? This red bar says caution. There's a possible top or a topping pattern in the short term. When you combine this double top with this red bar, that should be screaming at you, caution. It doesn't mean freak out. It doesn't mean sell all your stocks. It means caution. It means watch and pay attention because sellers are present in this area, right? Sellers were present here, sellers were present here, and now they were really came out in force here with this large red bar. Okay, that's all I'm saying. So if you have long positions, if you have stocks you own, this would be a good time to reevaluate where you're at. Do you currently have a profit? Should you take profits now? Should you raise your stops so that you don't give back profits? Should you consider selling the position? Right now, I certainly wouldn't consider adding to any position unless um, that particular stock is like on its own page. It's just extremely strong, and just again, that's what this is a signal. Let's go to the next fund. This is a representation of the NASDAQ 100 index. We use symbol QQQ to track that. Same picture as the SPY or the SPY, right? We've got a longer term trend, a monthly trend, a weekly stage analysis of trend, right? And then we have our daily trend. This is also showing signs of a near term top. So let's zoom into that one. Again, this chart is telling me caution, yellow light, watch out. Sellers are present in this area. It has almost a little bit different pattern than the SPY. We don't really have a double top, but we have this almost like rounding over. We're not making significant new highs anymore. And again, on Thursday, a large, wide range red bar or a range expansion bar. That just says caution, watch out. And we have a similar picture on the Dow Industrials ETF, symbol DIA. So this represents the large Dow Industrial stocks. I think there's 30 stocks in the Dow. They have a lot of weight. Okay. Again, a similar picture of these different time frames of what's going on with this market. And then again, when we zoom in to this 3-month daily time frame, what do we see? We can see some support areas here, right? Support. We can also see that double top, large, wide range bar, red bar on Thursday. Going all the way down to support, and then on Friday kind of reversing up about halfway into that bar. So if this support level is broken, that's a real big sign of which way the markets are headed. When we break support through price, that will generally tell us which way we're going, whether up. And this chart is telling me caution, watch out. And this is the final major market that I track, which is the Russell 2000, symbol IWM. These 2,000 stocks in this index are a much broader representation of the overall market and the overall economy. So the S&P 500 is 500 of the biggest, largest, strongest companies. The QQQ NASDAQ represents about 100 or more of the largest tech companies, right? The biggest, strongest companies in tech in general. The Dow Jones Industrials, the diamonds, represents the top 30 industrial companies. And this ETF gives us a broader representation of the overall market and economy in general. This one is interesting because, as you see on this quarterly chart, we haven't had really that nice clean uptrend that we had in the other three. And on the monthly chart, we even have more of a sideways trend or a sideways stage here. And then on the weekly trend, we actually have this pullback. We moved up, and now we're kind of drifting higher. We're not making any real strong moves. It has moved up this year, but in a very, I would say, an erratic way, not a very smooth move up. Okay. And on this daily chart, in the near term, almost just sideways. It's not very strong at all. So this would be an example of the overall economy, I think, is a little bit weaker than the biggest, strongest, largest companies. That's what I see when I look at this ETF. And again, when we zoom in, we can see on the daily IWM chart, the green line shows a resistance area. And price has broken that line 3 times, but could not hold that area this week. Caution with a range expansion bar on Thursday, that red bar, and price is now still in that range. So it's trying to break out of this range 3 different times and has not been able to sustain that breakout. So this is, again, an indication that the economy is kind of just back and forth, not very strong. And this particular, or the stocks within this ETF are not particularly strong either. Now let's take a look at what has been moving up recently. So another gauge that we use in the markets to confirm our suspicions of weakness is what's called the VIX. It stands for the CBOE, Chicago Board's Options Exchange Volatility Index. This is generally referred to as the fear index, okay? And the two things that I think matter on this index are the levels of the index and the spikes on the index. So the VIX is just a gauge of overall volatility. It generally goes up as risk increases for prices to go down. So 12 to 15 is generally considered a low VIX reading, which would be good for stocks and equities to move higher. 15 to 20 is elevated, not really a huge concern, but it does show a change. And then over 20 to 25 is considered high. This is just another tool to use caution at this time if considering a new trade to go long stock or to purchase stock. Okay, so we can see these spikes, and during the last year we had this spike up to about 23 or so, and then we had this move down, which indicated fear was coming out of the market, right? Whereas back here, fear was going into the market, causing prices to go down. Then we had kind of this back and forth, right? And you can see that level around 12 kind of showed where that level was at. And as the level comes down towards 12, that's lower volatility. As it spikes up, for whatever reason, at that point in time, volatility spiked. Generally, that is a big event like news, some major move in the market that day, or some market mover making an announcement. Like if something like Google makes an announcement, that could cause a spike in the markets because Google is a market mover. Or if there's an announcement about interest rates, or there's an economic report. So that's where you'll see these spikes. And that indicates a spike in fear. And then usually stuff settles down. And then recently, you can see here we had this spike up. And this index generally moves pretty quickly. So this index will look erratic. And that's just how it is. But you can see it spiked up over 5 days. It went up from, let's say, 13 to over 16 pretty quickly. So there must have been some news or event for those days. Or some expected event coming up. So it's just a gauge. Don't get hung up on it, but it just shows overall volatility increasing right now. Again, another clue to use caution. Now let's take a look at, again, what's moving up. Now this is just gold miners ETF that I monitor, symbol GDX. It shows gold in a pretty large trading range between the highs and the lows. And then recently we kind of broke out and gold miners are moving up in price, right? Indicating higher prices for gold, possible higher inflation, and maybe higher, again, a confirmation of higher volatility. This is another symbol related to gold, GLD, more directly related to the price of gold than the other one. Again, we can see a pattern on here, right? A little bit of a volatility contraction pattern, right? Or a consolidation, and then a breakout to the upside. So gold is on the move up. Home construction I put here because that has been a very good performer over the last couple of years. And recently we had a move, kind of a strong move up and then a sell-off in this home construction ETF over these last 4 days with, again, a wide range red bar on Thursday. I put that in there because home construction is kind of related to commodities and it's kind of like a core industry. I think that's important to keep an eye on. Copper also showed a very long period of time where it was in a range, and then buyers started to become willing to pay more for copper. And you can see the breakout to the upside in copper. Again, another gauge of increasing prices along with increasing demand for copper. This monitors the copper miners companies, symbol COPX. Again, a breakout in copper and a breakout for copper miners showing demand for copper. And again, another gauge of possible future and current inflation. Silver Trust, which tracks silver, symbol SLV. We've had a recent breakout of a range in silver. So again, reinforcing our, our premise, reinforcing our assumptions. Corn. Now this is ETF that just kind of tracks corn. I'm not 100% sure if it tracks the commodity, or if it's tracking like a bushel price or what it tracks, but overall, corn has been in a long-term downtrend. I think if I went even back to like a 5-year chart, it's been in a downtrend that long. Recently, but it's kind of interesting to watch because it tracks this agriculture market, which is a commodity. So recently, prices made an upward move over the last month, signaling or suggesting a bottom in corn prices. Another sign of inflation is food products use a lot of corn. One possible hedge against inflation, however, this price is not going to move very fast as it is related to a commodity. So it's not a very fast moving thing, but it's kind of interesting to watch that you could buy this fund and have some exposure to corn without being a farmer. I found that kind of interesting. So, and a possible inflation hedge too. So let's get into a few of these sectors now that I track. This just simply tracks the overall energy sector, symbol XLE. It's got an interesting pattern on this one called a reverse head and shoulders. I just drew that here for you guys. This would be kind of what a head and shoulders pattern would look like. The reverse head and shoulders kind of can signal higher prices, and it did, right? So you can see the head and shoulders here, and then a breakout to the upside in energy. So energy as measured by the XLE has been in an uptrending bull market since February of this year. To me, this is another sign of inflation and our dependence on energy. I would not buy this right now as it is quite extended, and there has not even been a pivot since February. When it comes to pivot analysis, that's kind of important too. But this is a very strong sector right now. An entry here would not provide a very good risk to reward. Mid-February, we did have a range breakout to a higher, tighter level after an unclear reverse head and shoulders pattern. But since then, it's been straight up. So I'm just talking about this pattern here. We're just kind of went sideways, right? And these bars were kind of wide. Then all of a sudden, it just kind of broke out. It had this little buy set up, and then it got tight. So this higher level, or this higher, tighter range, could have been a pretty good entry in hindsight. Again, this was in kind of a downtrend, stage 4 downtrend, and then it kind of went sideways for quite a bit of time here. Then it just broke out. So that's why it's important to kind of keep an eye on these different sectors for opportunity, okay? And I'll show you why. So this is just what's called an ETN, which stands for an exchange traded note. And I don't have time to get into what that is today, but overall oil itself, as far as crude oil, has been in kind of a slight downtrend, okay, or a range. But this symbol oil, this is just for tracking the crude oil market. Been in a downtrend, but I also use symbol USO as a gauge of oil or energy industry activity. I prefer that one as an ETF. You can study the difference between an ETN and an ETF in your spare time, but still interesting to track. Okay. So USO, which stands for the US Oil Fund, has been in a near term uptrend. And we can see on here this price contraction pattern, right? We had resistance, resistance, and resistance. And over this period of time, price slowly moved up and contracted and then broke out to the upside. I prefer to use USO to invest in oil over the oil ETN. Can you see why this pattern provides a good risk to reward because of the tighter stop before the breakout, allowing you to buy more shares per your risk management plan? So we're getting a tighter stop loss on this pattern, which allows us to buy more shares, potentially giving us a greater overall reward. Then here's another ETF I follow related to energy. This is the S&P Oil and Gas Exploration and Production Spider, symbol XOP. Energy, oil, and gas exploration is in an uptrend. It's been almost straight up since February. So again, we really don't have a good risk to reward entry right here. So let's just watch and wait and see what happens with energy going forward. But again, all of this should be putting together a picture for you by now as to what's really going on with the economy. Another one I watch is called the VanEck Company Oil Services ETF, symbol OIH. Oil services has been in a bull market along with energy since March. Notice the 3-bar sandwich this week. We get that green, red, green, that sandwich where buyers sandwich the sellers. So that's a bullish indication of more continued price appreciation. So that's pretty powerful. Not really a pattern, but just a more bar by bar analysis, that 3-bar sandwich. Here's a company within the energy sector, Dorian LPG, symbol LPG, showing kind of another thing I'm looking for are buy setup or a 3-bar turn. So LPG is in the energy sector. It's went through a transition back to an uptrend after a price correction in February and March. That's right here. See where this is correcting through price and time, where prices came down. Notice this red moving average line is still moving up, indicating the long-term trend is still up. We had an earnings event here. And then over this time, prices corrected and got tight here over the, I don't know, 10 or 12 day period, and then broke out on this green bar on increased volume. So now I am looking for a buy setup, 3BT, after, right here, after Friday's bottoming tail candle, right here. Also notice the green grain expansion bar on Monday here after this tight consolidation. Notice the volume increase. These are all clues to bullish price action, or our expectation that prices should continue higher. So here on Monday, and I didn't look at this today as I'm making this, but if I saw this pattern show up here with a nice green bar about the size of this red bar, I would consider buying that over that green bar as a high probability bullish setup, expecting higher prices. So this is an energy company within appreciating energy sector where oil is increasing, oil services are in a bull trend, and commodities in general are in this bullish uptrend right now. So this is a company within that area. So we're looking for opportunity. Here's another company within that same energy sector, Oil States International, or OIS. This is an oil stock in a transition after it's been in a downtrend. You see this long-term red line, long-term moving average in this downtrend. Okay, so this stock was or still is in a downtrend on the longer-term time frame. So now we're thinking to ourselves, can price play catch-up to the other leaders in the industry? So this is just a company that's kind of lagging behind a little bit to the other major players in the oil industry. So they're probably just a smaller player, right? They kind of probably have to play by the rules of the big guys. So we will see. Notice the volume spike and the recent 3-bar sandwich again. Remember, so things repeat, right? We have this downtrend, 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 and we start to get some smaller candles in a transition where it's rounding back up. We get a volume spike, larger green bar, kind of this new level. It's looking like this could start to break to the upside, possibly. So maybe that's one you guys could watch here in April. Again, oil company within the oil sector, within the energy sector. Now this one has not performed at all. I threw this in here just to show you that just because everything in a sector such as energy is in a bullish trend or an uptrend does not mean everything will be that way. So here's an example of U.S. natural gas fund, or natural gas, symbol UNG. So UNG is still in a downtrend or a stage 1 bottoming pattern. There has been no change to this since last month. So this is not one I would be interested in right now as a fund to buy for appreciation. It just hasn't shown any evidence, right? As we are price detectives, we're looking for evidence. In this particular fund, I'm not seeing evidence yet that this is actually ready to move higher. So that's the point of that. This is another one I track, the US dollar index, and we can see a peak on this chart. We can see a bottom and kind of a return to an uptrend, or at the very least, a sideways trend after a move up. In general, as the dollar, commodities, gold, copper, silver, and interest rates go higher, that is usually negative for stocks and equities for two main reasons. Inflation is reflected in these items, and these costs will filter down to the end user or consumer. Two, because the companies that use these raw materials will have higher material and labor costs, and this will affect their profits. Also, keep in mind some sectors or industries are more affected by commodities or interest rates, such as housing. Well run companies and households can shield themselves from interest rates by not borrowing as much or not borrowing at all. Some companies have no choice but to borrow to stay in business. So think of a new company starting out that needs to be capitalized. They're probably going to use debt to do that. Okay, so I hope this has given you guys an overall picture of how I'm looking at the markets and the economy and where I'm looking for opportunity. This is just an example of the 1 year T-bill yield. So this is related to interest rates, right? Short-term interest rates as measured by the 1 year T-bill yield have been slowly moving up since February. Price or yield is closing above our three moving averages, which are sloping up, right? So this is telling me there's still inflation. And then interest rates continue to drift higher and be stubborn, closing the week at 4.37 as measured by the 10-year note. So that first one we looked at was a 1 year note. This is a 10-year note. This would be one gauge of inflation, and in general, higher interest rates are negative for stocks. This is still an uptrend. So you can see we have this downtrend in interest rates from October through the end of the year, and then we started to get these higher low pivots, right? So indicating just another indicator that we're now in this uptrend in interest rates since the beginning of the year. Then bonds, which are the inverse, which behave the reverse of interest rates, have broken support in a downtrend. Bonds are inverse to interest rates as measured with this ETF symbol TLT. So as interest rates are going up, bonds generally go down. You can see these lower pivot highs, right? Lower pivot high, and then you have the support area. Well, we just broke that support this week, indicating bonds falling, interest rates going higher, right? So this is an interesting to watch too. There's something called inverse kind of leveraged ETF. So this is called a 3X S&P 500 Bear ETF, symbol SPXS. So it behaves in a way that moves 3 times as the S&P 500 moves, only in reverse. So you can see as the market has moved up, this ETF has moved down. So this is a hedging tool. That's what it really is. And or a trading tool. It is not a long-term investment. Okay, it's really just a tool. Another way to hedge our bets against the market that may turn down is to hold our long-term ETF funds, like the SPY or other index funds, and at the same time stay in the market and buy an inverse ETF, like this one, symbol SPXS. This fund will go up when the market goes down. Timing is everything with this type of hedge, and these funds are not considered a long-term investment like a mutual fund. It would be used as a short-term strategy, offset any downturn in the market. Another option would be to move some money into what is going up, like corn or gold or silver, or areas that are producing positive results, like energy. Even simply putting your money into a money market or savings account at 6% is not a bad idea. Long term, however, the stock market has generally outperformed most other asset classes. I am simply saying do not forget to diversify into other assets or look at other areas in changing economic situations, especially as a trader. And you can see here as the market spiked down Thursday, this ETF spiked up that large green bar on volume. So it moves in reverse to the overall S&P 500 market. This ETF symbol MJ is a measure of the marijuana or cannabis sector. There was a long price base since last year, and even longer if you look at a weekly chart. March price tested the highs of September. I would expect a pullback at this month, especially after the wide range bar on Thursday. All right, so here's long-term resistance. We hit resistance here on Wednesday and Thursday and pulled back. Also, MJ is not diversified. Consider other ETFs such as symbol YOLO for exposure to this industry. Also, this industry in general has had issues with being profitable and some regulatory and legal issues. So use caution if you're going to invest in the cannabis or marijuana or what are they called? Consumable sector or some of these therapeutics. That's another term they use in therapeutics. Just be cautious. Not that you shouldn't invest in that sector, but it has not moved a whole lot so far. It's kind of been disappointing, to be honest. Again, here's another example of a cannabis ETF, symbol YOLO. Um, it's a different ETF, which I prefer over MJ because of the way it's diversified inside of the fund. Recently, price made an upside break. Notice how price is pulling the moving averages back up after a correction over price and time. So these three moving averages, price kind of pulled those down a little bit. Now price moved up and is pulling the moving averages up with it. Again, moving averages are just tools we use on a chart to help us decipher the information on the chart. Moving averages are not price and are not support or resistance. They just represent price over a period of time. And one thing you should do with any ETF is look within that ETF, see exactly what do these ETFs own. And this symbol, YOLO, owns a more diverse representation of the companies within that sector versus MJ. That ETF only owns MJ. It's kind of weird. I don't know why they did that, but I didn't realize that until I looked and actually saw what was inside of that ETF. So an ETF is just a fund, owns different companies within that fund, and they can vary the weighting or the percentages of the companies within that fund, giving you either broad diversification or not so much. So it's important to look inside an ETF and actually know what you own within your ETF. I'll let you guys do homework on that. This is a company within the cannabis industry, symbol MAPS, which stands for WM Technology Inc. So here's one from the cannabis sector that we highlighted last month. So this chart's from last month. It was, I took a screenshot, and you can see here's the long-term trend. The short-term trend is starting to move up. You can see the higher low area, and then another higher low area. And then this month, with technical analysis, you could trade any price stock or ETF as long as you have reasonable expectations. So with this particular company, it's not a very expensive company, which means it's not very valuable. I do not expect this company to go too far, as it is a newer company without profits, right? So I closed the trade on the move higher, took profits, and moved on. This move from last month, right at 97, 98 cents, to this month up to as high as $1.40. This move up was about a 47% move, but the dollar amount was within my trading plan limits for money and risk management. Okay, so again, good luck. I think money management is very important. And also our expectation is important. So should we expect a company that really doesn't have profits yet? It's a new company. It's priced at, basically a penny stock. Should we expect that to go to the moon? No, we shouldn't. So I took profits on that one. Could it go to the moon someday? Yes, it certainly could. Anyway, let's move on to next. What is not moving up recently? Some sectors and stocks are showing signs of topping out or weakness. So now we're going to we looked at what was going up. Let's now look at what's kind of showing weakness. So this is a robotics and AI, or artificial intelligence ETF, symbol BOTS. It has a nice uptrend since October. The pattern shows a topping pattern, a new high, and then some selling over the next few weeks. Okay, well, you can see right here, made a new high, strong move up, and then over the next few weeks, we had some selling, and then it rolled over. However, consider this a tech ETF and a future new industry. So how would I manage? Let's talk a little bit about trade management. So you could sell some if you have a profit. If you had 100 shares or more, you could sell one covered call for each 100 shares to increase your income and or lower your cost basis. You could just simply hold on to this ETF if you really like it. You could raise your stops if you think this is going to make a large move down. to protect yourself, you could raise your stop. So here's one where you kind of have some choice, right? And it's just trade management. Also, this is a good time to study, also consider the companies inside of this fund. So are these companies you really want to own long term, or was this a short term trade for you? Know what you own in your funds. You may really like or dislike what is in the fund. So this is an interesting one to study because, again, it's a new industry, it's tech, it's AI, and it probably has a good future. Right now, it's showing some near-term weakness. This is a symbol FDN, which stands for the Internet Index ETF. Um, this ETF is still in an uptrend, but Thursday's large red bar, again, is a warning, so caution. Still in an uptrend, but caution. This is one I watch too, the transportation ETF, because transportation is pretty much a huge part of the economy and really affects a lot of what happens um, as far as products being transferred over distances. Again, this is showing a short-term topping pattern, flat, new high, and then price does not make a new high after a pullback. Now price is rolling over under the 20 period moving average, the blue line. So again, caution. Okay. This is a company within some of these ETFs, symbol RBLX, which stands for Roblox. Roblox is an example of a stock that had a positive gap up in price on an earnings announcement right here. Okay? Price gapped up on earnings, but then sold off continually over the next several weeks. I drew some support areas, which are these purple lines. Can you see these here? We've broken support. And after this, right here, after this red bar gap down under support, your assumptions were wrong if you thought this stock was going up and you were long. So you should have stopped out or you should exit this now because this gap down and this break of support is an indication and a suggestion that prices will probably be going lower for this company. So again, breakdowns and breakouts work both ways. So just because you own this and it had a positive reaction to earnings initially, we now have more evidence, right, as a price detective that, well, that was just a short-term, gap up. It didn't. There was no follow through to the upside. It actually followed through to the downside. So here's a cloud computing ETF, symbol SKYY. This is showing, kind of this increasing price uptrend, almost a wedge pattern right here, and then a breakdown or a gap down on Tuesday, red bar on Thursday, but a little bit of a recovery on Friday. So this is actually, you know, maybe showing some strength. It's still an uptrend, but a flat top and price sitting on the rising 50 period moving average. Caution, price could go up or down. It could go either way here. So there was a wedge pattern, but this last week may have broke that wedge pattern in my opinion. So this is a situation where maybe the companies within this ETF are okay, but the market is kind of pulling this ETF and those companies down. So markets can pull down prices in other related sectors or other related industries. This is the semiconductor sector, symbol SMH. It's still in an uptrend, but a lower range and a wide range bar on Thursday after an all-time high is a warning sign for this sector. And a pullback is not unexpected in this sector, as this has been extremely strong this last year. ETFs have just been a true market leader. Here's another sector. This is the industrial sector, symbol XLI. XLI industrial sector related to the, the Dow Jones ETF DIA is still in an uptrend. But the red wide range range expansion bar on Thursday, again a warning sign, but then there was a nice recovery on Friday. So there's a little bit of relative strength in this sector compared to some other areas, right? In this case, yes, we had that large red bar on Thursday, but the price itself is still above all of the moving averages, and we're still in an uptrend. We have not broken support on the industrial sector whatsoever. But this is a case where the markets affected this sector. So I hope that makes sense there. This is S&P 500 technology sector, symbol XLK. XLK technology sector is in a topping pattern in an uptrend. Looks like possibly rolling over. There's a large red wide range bar or range expansion bar on Thursday. Caution. Price closed below the 20 and 50 period moving averages. So can you see the difference between industrials closing above all the moving averages, right? And technology, the sector closing below the 20 and the 50 period moving average with a wide range red bar. Hopefully you guys can see that difference. That's an important difference of relative strength versus something that looks like it's rolling over, possibly lower prices in technology. This is ETF XLP, which represents the consumer staples sector. So consumer staples had a down week. Price broke the 20 period and 50 period moving averages. And price broke pivot support this week right here. So here's pivot support, we broke that support. This is clues as to price direction. If I own this ETF, I would consider selling half or more to lock in any profits I had and avoid any major new downtrend. However, this sector moves slower and the companies generally do well in a down economy as consumers buy items over and over again, creating cash flow and profits and dividends for investors. So if you have a good purchase price, then you may want to hold on for the future, right? So if you bought way back here, you have a good cost basis, you may just want to hold this for dividends and for the future. It's it's one of those things where you need to know what is your position. So this is the S&P 500 healthcare sector, symbol XLV. Healthcare, the picture is very clear. This price has broken major support. We have a triple top with a gap down Tuesday, followed by a red wide range bar on Thursday. Price closing under the 20 and 50-day moving averages. If I was in this ETF, I would exit this position as a trader. Longer-term investors may find value as prices decline further. So there's a different thought process as a trader, right? Long-term investors love when prices come down because it allows them to find value at lower prices. Again, this is a range. Just drew this for you. This is a range breakdown pattern, or a BD right here, right? A range breakdown. Prices don't always break out. They also break down. So here's a high, a lower high, another high, where it's all kind of that triple top and then it breaks down. So that's a clear cut case of this sector is being sold at this time. And then we have the consumer discretionary sector symbol XLY. XLY consumer discretionary also broke down this week on Tuesday and then again on Thursday. This pattern has been playing out since December. So you can see since December, this has just been in a very large trading range. A little bit of an uptrend there, but then it's breaking down. So it's just in a big range, not really moving higher. Price closed under the 20 and 50 moving averages and under, this pivot support. So moving averages, again, are not support. This pivot support or this price level is support. So the moving averages are just a guide. I want to be very clear about that. But again, this chart is showing that consumer spending is falling off, right? So the consumer may not be as strong as was predicted. So let's move on to just a few stocks for April to watch and consider. So this will be our final portion of this video. This is one that in disclosure, that I do own. But what do you notice about the transition on this weekly chart of Blue Owl Capital symbol OWL or OWL? So what do you guys notice about this transition from a sideways trend to an uptrend? What are some clues we can look for to maybe try to predict or to expect higher prices? So I'm going to just, this chart is from February 2024. Price closed at 1778. So my question to you guys after this whole presentation is, does technical analysis work? What do you notice about this transition from a sideways trend to an uptrend? What are some clues that you can pick out that would help you maybe try to get on board of this opportunity? Okay. So I'll just leave this here for 5 or 10 seconds and study that, pause it, whatever you have to do. So here's this chart down the road, right? Here's the same stock about 6 weeks later with some price appreciation since February. Had an earnings event, positive reaction. Also notice some relative strength as on the same day, this Thursday, all right, markets sold off or even gapped down, but this stock had less selling and a green bar the next day. And this stock is still in an uptrend. So a little bit of relative strength on this company. Let's look at this one now. This large wide red bar or candle indicated lower prices, but there was no follow through occurred. So we had an event, wide range red bar, but there was no follow through on that bar. Price never really went below that red bar. A price consolidation did occur, so that's another big clue. So we had this, price moved up, and we had this big bar, but then price just kind of consolidated over the next, month and a half. And notice this long-term moving average, this red line. See how that kind of changed? Where it was in a downtrend, and it started to curve up. That's because this price action caused the moving average to curve up, right? Again, we have a 5 to 6 week transition period before the stock price turned back to the upside. So that's a major company, Dollar General. So again, can you see a possible opportunity there to buy a major stock after it was in a downtrend, and then we had this transition period? Can you guys maybe see some opportunity there now? Okay, next. Notice that transition clues with Dollar General in a downtrend on this 9-month daily chart. Price action was sideways after earnings, and price movement contracted over the next 4+ weeks. Right here, you had earnings and then price contraction, giving us a nice risk to reward entry for a trade, expecting a break to the upside or prices moving higher. Notice how price was below the moving averages and then followed that, that blue line, that 20 period moving average for several weeks. It just kind of price hugged that moving average line for several weeks, giving you several opportunities to buy Dollar General stock expecting higher prices. Okay? Amazon. Let's say a similar transition occurred in Amazon stock back in January to April of 2023. So this is, again, I'm just showing you guys some transitions here because these are great opportunities to buy major companies at discounted prices. This is like a sale. Think of, you're going to the store and you're looking every week or whatever, whenever you go to the store, and all of a sudden you start to see stuff on sale. This is what we're doing with this, looking for these stocks that are coming out of a downtrend back to an uptrend, especially with major companies like Amazon and Dollar General and others. So this happened back in 2023. Just an example of a chart that you could have been watching, looking for opportunity. Okay. And now Amazon, as of March 2024, is in a higher range. In this situation, we will be looking for a base and break. We need more clues as to whether price will move up or down from here. Again, Amazon is a leader. It's in tech, retail, transportation, and has been a good stock to own, right? It has earnings. And now we're looking for a chance to either get on board for the next move higher or use other strategies to take advantage of Amazon stock. This is symbol INFA for Informatica. I don't know much about this company, so we're just going to use technical analysis on this one. But there's a possible, positive reaction to earnings, and then kind of sold off, moved up, and now we're getting a little bit of a buy setup here, followed by a range expansion green bar with a new high. That little symbol there means it just made a new high. So this looks like this is going to break out to the upside for whatever reason. So that's one you guys can watch or look for an opportunity. Let's think about that for a second. Why is this stock, making a new high on Friday after the market just sold off big time this week? So again, something called relative strength. How about DoorDash? Very popular. I believe starting to making money, and prices moved higher after an earnings event. Did sell off Thursday, but I would say not significantly. In fact, price actually gapped up from here to here and then sold off. And on Friday, prices kind of recovered. So DoorDash, I think, is seems to be a pretty strong company right now. Uber Technologies, not super strong right now. More consolidating within a range. Did have a new high in March, but between all these rideshare companies, Uber is the leader. And so this is a situation where, yes, the market has been selling off. This has been consolidating, but it doesn't seem to me like there's a whole lot of willingness to just sell Uber right now. In other words, people are just kind of holding their cards and holding Uber for the longer term is what I see here. Let's compare that to Lyft. Lyft, which has been lagging Uber in price, is did have a more significant sell-off this last couple of weeks. Thursday sold off. Friday had a little bit of a recovery, but the problem with this is where it's at. This would be considered support, and this is right there. So if that breaks that support, it's probably going to come down to at least here. So that looks to me like that could sell off some more in Lyft. Here's another one I found through my list. Arhaus Inc., symbol ARHS. Again, had a positive reaction to earnings. This went into this little bit of a wedge or a little bit of a price contraction pattern. Actually gapped up Thursday and then sold off. And then Friday gapped down but recovered quickly. So this is showing a little bit of stability and relative strength compared to the other stuff we looked at. I don't know much about this company. And in disclosure, I do own some shares of this. One advantage to using some type of platform, whether it is your broker, a chart service, or an alert system, is you can get updates on stocks you are watching. Right? At the end of the day, I get an email of a summary of my watch list from Barchart, which shows what happened today. I don't watch the markets all day. I don't have time. For example, I can see that today, Monday, the April 8th, the SPY moved from open to close only 0.06%. So not much happened today. However, symbol EAT, which is a restaurant operator, moved open to close almost 4.5% today. So that is one I would then look at the chart or other news or fundamental information for further analysis. So this keeps me more time efficient and focused on what's moving versus what's not. Anyway, thanks for watching, sharing, liking, and subscribing. I hope this helps reinforce my approach and what I am looking for on good risk to reward trades. Good luck from Phil at Laptop Trader on YouTube. Again, my contact is laptoptraderphil@gmail.com. We'll see you guys next month.